Hi, I'm Bo Apele with the Ohana Realty Group. I'm standing here today with Matt Williams from Sunwest Mortgage. Matt, one of the questions that we're always getting, or that a lot of purchasers will ask, is what is PMI and MIP, and what are these things? What do they mean? Can you explain that a little bit for us?
Yeah, definitely, Bo. Thanks for having me. So it is kind of confusing, PMI versus MIP. Just to explain that real quick, PMI is something that you are going to be dealing with if you're doing a conventional loan, and MIP is something that you will deal with if you're doing an FHA loan. So what PMI is private mortgage insurance, and then MIP is mortgage insurance premium. But they really work a lot alike. They are there to protect the lender from default by the borrower or foreclosure, those types of things. And so it's really to protect them. And it also allows a borrower to get a really good rate even though they may not have an adequate down payment. So on a conventional loan, if you are going to be putting down less than 20%, you're going to be required to put have to pay a private mortgage insurance. That can fall off after you get to the point where you have enough equity in the loan, and it's not something that's going to be for the life of the loan. It's just to protect them at the very beginning until you have adequate equity. With mortgage insurance premiums with FHA, it works a little bit different. So as of 2013, some laws have changed there, and the requirement is if you have 90% or more equity in the property, so you've only had to put down 10% or more, then you're going to be required to have mortgage insurance for 11 years. But if you have less than 90% equity, say you're at 91% loan to value, or only have 9% equity in the property when you purchase, you will be paying mortgage insurance on an FHA loan for the life of the term. So those are some quick differences, and I hope that answers your questions.
So there's a good benefit to going with, say, a conventional loan as opposed to an FHA loan, simply because you could drop the private mortgage insurance at some point.
Yeah, if you have really good credit, let's say you're a 680 and above borrower, and you have the option between going FHA or conventional, I would pick conventional just because your mortgage insurance premiums are going to fall off, or your PMI, private mortgage insurance, is going to fall off, even if you don't have that big down payment. And FHA could be following you for the life of your term, and you'd be paying that extra money, and it's not going towards your principal or anywhere else, and so it's just a payment that's just going off into the wind.
And that can be quite a bit on their mortgage payment as well. I mean, we're talking several $100s in some cases, right?
It can be, depending on the higher loan value. So if you're buying a jumbo property or something, $400,000, $500,000, $600,000, your mortgage insurance premium is going to be very, very high, and you could end up paying that for the life of the term.
Awesome. Well, thanks a lot, Matt. We really appreciate you answering that question. If you have any other questions for us, please feel free to contact us. Our contact information is listed in the description of this video, along with Matt's contact information, so you can reach him with any of your other mortgage-related questions or for a mortgage approval. We look forward to hearing from you soon. Have a great day.
Thank you.